She now sees 2 hikes on the horizon as inflation becomes a bigger issue. Let's bring in Diane Swonk, the chief economist at KPMG, along with CNBC senior economics reporter Steve Leisman. They're both here for our opening exchange. Welcome. Diane, I'll give you the mic first, so to speak, but what jumps out to you about this report? I mean, literally so strong, you think that we should now be talking about hikes?
It's not the report itself. I don't think the job market is actually underlying. I think it is still very weak. Under the hood, the report was still very weak on the household side of the survey. And the U6, that sort of underemployment number, jumped up to 8.2%. That's the highest level since December. So I'm not exactly thrilled about the headline figures. I don't think they match what most people's experience are. That doesn't mean that rate cuts by the Fed can do anything to cure what ails the labor market. And we do have a much more sticky inflation situation that I think is going to persist much longer in response to the war in Iran as well. I think this is going to be a much harder situation for the Fed to deal with as we get into the summer, and that's something I'm very concerned about going forward. We've seen inflation expectations even in the New York Fed survey move up on the longer term end of the inflation expectations as well as in the near term, and that's something that you don't want to see. We've really got a muscle memory out there of raising prices now that we haven't had, and the Fed's missed its target now for 5 years.
Dean Mackey, I think it was yesterday, said we have 3.2% core inflation, which is the highest reading for 30 years going into the pandemic, which is, not anything to look past. But at the same time, if this is a price shock and not an inflationary environment where we've seen monetary stimulus and fiscal stimulus, should we treat it more as a tax hike, even something to be kind of where you'd loosen policy? I think it was the Bernanke research that said this, Diane, that said the Fed's mistake in response to oil shocks of the past was to be too contractionary with monetary policy.
Well, this one, I think, is different, and I don't think it falls under that category. What I worry about is that we're seeing multiple shocks at once, and there are ripple effects. This is not just an oil shock. It is a supply chain shock that echoes the pandemic, and we do have some fiscal stimulus still. We are having extra expansions to tax cuts that are showing up in tax refunds, which are blunting the blow in terms of retail sales. That also is a double-edged sword because it helps to make inflation stick at a time when we already know inflation has gotten sticky. I really do think that the new Fed chairman's inflation fighting resolve will be tested by financial markets. And I think the Fed has been a little too dovish in terms of inflation, given how sticky we've seen it, particularly in supercore services, stripping out just even the core number, going into that supercore services, accelerating prior to the shock from Iran. So I don't think this is just an oil shock. I think it's much larger. We also know that research from the pandemic shows that persistent shocks amidst elevated levels of uncertainty makes for more persistent bouts of inflation that central banks should be taking notice of and not making the same mistake they did coming out of the pandemic.
And Steve, wasn't this why we saw at least 3 of the 4 dissents? Weren't they in favor of?
Yeah. Hey, guys in the back were yelling at me for being late coming down. The reason is because in serendipitous anticipation of Diane Swonk bringing up services ex inflation, we made a chart on that.
And you made it here in time. You were fine.
I was on time. I was fine. But take a look at the chart that has it's services, ex energy and food, and ex shelter as well. And you can see it's a little bit elevated. Maybe they don't have it, but in any event, it shows a tick up here. I want to go back to something that Diane said at the top, which is important. There we go. PCE services, and that's the 1-year bar. And then go back and take a look. We have a longer term chart of this, and it shows what the problem is. It's not that it's 3% now. It's that it normally was running at 2% before the pandemic, and now it's 3 and change, and that's the problem, putting that upward pressure. And that's what Goolsbee talked about with me this morning. He said it's not just the energy side of things. When I take it out, I'm still worried about inflation. The important distinction that Diane made at the top is you may not want to raise rates because of the job market. There isn't a sense right now that the job market is creating inflationary pressure, especially when you have wages 0.2%. You had a slight uptick in hours worked, but there still seems to be the ability to work the existing workforce more, and of course paying them more, and not have inflationary pressure or get into a tight labor market. The reason you would raise rates is you'd be the Fed. You're like, okay, I got 2 mandates. I got the jobs mandate. I got the inflation mandate. I look at jobs, I don't have a problem over here.